Dan, good morning.
Good morning.
We're finally making this happen. We've been talking about doing a podcast about AI and the capital markets, and here we are. So I'm Paul McKinlay. I lead the innovation banking business at CIBC. We bank and lend money to enterprise and B2B technology businesses and AI businesses. And I'm here with my colleague, Dan. Dan, introduce yourself.
Thanks, Paul. I'm Daniel Lee. I'm a managing director within our capital markets business, where I advise technology companies, founders, investors on transformational transactions. So what does that mean? It means mergers and acquisitions, IPOs, and late-stage capital raises.
And you, I think of all the people in our groups, have gone down a serious AI rabbit hole in a big way, which is amazing. And so that's what we're here to talk about today. So let's go for it.
I've secretly been like a science and engineering wannabe nerd my whole life, just never been smart enough to do it. And so now I armchair quarterback.
Amazing. So a couple of weeks ago, maybe a month and a half ago, there was that week of SaaS apocalypse, like the SaaS software public markets.
Oh, is it over?
Well, not quite, but it kicked off then, let's call it that. And maybe peaked, but it was in the news, and the Wall Street Journal, and Bloomberg was covering the death of software. A lot of it kicked off by this Citrini research report, which we'll talk about in a second. But like, in your mind, what peaked all that? How much of it was perhaps was going to come at some point anyways? Or like, what was the point that kicked that off?
I actually think this preceded the Citrini research report. I think Anthropic's releases of the different plugins within Claude and Cowork was really what started the first wave.
I guess that legal one that they came out with.
The legal one that they came out with resulted in a sell-off of something close to about $300 billion in software stocks that week. And then they followed up with a security plugin, which followed it, which resulted in another wave of sell-offs. The Citrini report, I think, just fed into all of that pre-existing drama, and it wasn't really a report.
It was more of a hey, this is kind of what the world may or may not look like in 2 or 3 years, but it got enough attention rolling around all the trading desks and whatever in New York that it fed into the narrative.
Oh, it totally. And we have been very much in a narrative-driven market over the last couple of years or so.
Yeah.
Part of it is AI is doing two things. On the one hand, it's created a lot of, I don't want to say froth, but it's driven valuations up across certain spots in the Nasdaq, like the Mag 7. Anybody who's within sort of that monetization of tokens. So it's driven valuations up on the one hand, and then on the other hand, you've got commentators out there saying, "Hey, where's the ROI?" Right? And so when you start pricing things to perfection, any sort of headline that could shift the narrative and shift what those longer term tails look like moves the markets in pretty big ways. So the Citrini report was just another variation of that, where the markets reacted to headline sensitivity.
Yeah, big time. What I think is interesting about this debate too is the week that came out, I was in San Francisco, running around meeting with as many venture and growth equity investors as we could, and made a point of asking every single one of them, like, hey, what's your perspective on the sell-off in the markets? And the debate of software is totally dead versus the other side of the coin. And I think it was really interesting is you got like a totally different answer than what you would have read in the Wall Street Journal and Bloomberg. It was like, listen, this is a much more nuanced debate than black and white, software is dead or it's not kind of a thing. And so you have like Thoma Bravo and Andreessen and all these, storied funds that spend all day, every day in software, taking the argument of, listen, this is much more nuanced. There are companies that are going to be challenged, but there's also companies that are going to get a tailwind from this, and those that do an amazing job of like adopting it internally, adopting it into their products, there could be a benefit from it. So it's not as black or white as a debate as the media made it seem, or even the market's sold off to.
Oh, 100%. I think it's been overblown in a number of areas. The way I think about how it impacts different categories of software differently is really along two axes. One would be around the complexity of the workflow that you're solving. And then the second would be around data governance and compliance. And so when you carve it up that way, you end up with really 4 boxes. You've got companies within software categories that have fairly simple workflows without much in the way of a data or regulatory moat. They're in trouble, I think. You've then got software companies within categories which have some fairly complex workflows, so they own the workflow, but they don't really own the record, and there's not a lot of data gravity. I think those are challenged categories because the pace of competition within that is just going to continue to increase. And then I think there are categories of software where the workflow may not be all that complex, but they've got great data gravity or a regulatory moat. And I'm thinking specifically of vertical market software, right? Where you've got really deep domain expertise, you are the system of record, nobody's going to vibe code that.
Right.
And then you've got this fourth category that I think is fairly entrenched. And you're not just the system of record, but you're also a really complex workflow throughout multiple categories within an enterprise. And then on top of that, you've got the data gravity, and you're in a category where switching costs aren't really driven by how good the software is, but it's around operational complexity, compliance, data governance, all that good stuff. So these are large platforms, you know, somebody like a Workday or an SAP or ServiceNow, really difficult to rip out.
Yeah, there was a quote that like, how many ServiceNow tickets, how many bugs have been fixed in that over the last 20 years? And the answer is probably millions and millions and millions. And so like companies and enterprises that leverage those platforms, those big platforms, there's a stability to those things. They might not be perfect, but there's a stability to them that gives them some staying power, certainly within certain end customers. The other thing I think about a lot is like, if you come into work, if you work at a bank like we do, or some other big institution, you come into work, like what are the systems that you log into every day? And if you didn't log into it that day, you couldn't really do your job as effectively, and they're connected to other points. Like, not to say that they're going to last forever, but like those probably hit in that top left quadrant that you're talking about of around durability. And then there's a spectrum of it that goes from mission critical, can't do my job without it, to if I didn't open it for a week, that's probably a different story.
Yeah. You know, I think, but there's so that's as it relates to durability, i.e. terminal value risk.
Right.
I think there's less terminal value risk within those two categories.
So for people listening and watching, like talk about that, because that's something that got a lot of attention, was that the terminal value has basically been considered zero, and that's what the public markets were pricing. Not everyone builds DCFs and knows what that means. Maybe give the one-on-one on that.
Yeah, absolutely. So the intrinsic value of any company is the discounted value of its cash flows. And oftentimes these models build on 5 or 10 year cash flows, because you can probably forecast those. And then at the end of that period, you've got something called a terminal value, which would, and there's a couple of ways of doing it. It's either based on some sort of multiple, or you take that last period cash flow and divide it by the discount rate subtracted by the growth rate. In most discounted cash flow valuations, the terminal value could represent 60, 70, 80% of the entire value, which means that the longer dated cash flows are worth more. The durability argument around terminal value, and the argument that terminal value for these companies could be zero, is that in 5 or 10 years, these companies may not exist at all.
And so the only value in it is the cash flows between now and that.
The only values are the cash flows today.
Right.
Yeah.
Interesting. How have like the public markets well, we talked about how the public markets reacted, but like relative to the private markets, because in our day-to-day, I feel like we've gotten 2 different reactions, 2 different answers to some extent. Like they're starting to combine But how did like the folks you talk to in the private markets think about what's going on relative to the public markets? And is there a disconnect there? I think there is, but I'd love your.
Well, it depends on which set of investors. The set of venture investors who are looking at high growth AI native businesses, they're all in. These valuations are 50, 60 times revenue. The private market investors, the private equity investors,
if there's any revenue, by the way,
if there's any revenue, the private equity investors who are looking at software buyouts in the private markets, they're a lot more cautious these days. They used to be able to underwrite to sort of mid-teens EBITDA multiples as a terminal value or as an exit value. They're not so sure that that's the right way to look at it anymore. In fact, a number of the firms that we talk to have been reevaluating how they think about that, which is not that dissimilar to how public markets investors are looking at it. However, where I would say the distinction is and within the private equity investors anyways who are doing these buyouts, they're seeing an opportunity because the software sell-off has been indiscriminate across the board. And
what a lot of these software in general, as opposed to taking a nuanced view that we talked about, right?
Yeah, exactly. And so what we're seeing is some of the bigger name private equity investors like a Vista, like a Toma, like an HG, they're building their own AI agentic factories. And the whole thesis around it is we have this opportunity to purchase what could be an AI native company right now in the public markets for 3 or 4 times revenue, like
when a year ago it was trading for 12.
Or even 12, 15 times cash flow today. And take it out of the public hands, implement, not just implement.
Like an agentic playbook for those companies.
Not just implement. Reinvent these companies to become AI native at this sort of entry multiple, and then take it public again or sell it to a strategic 3 to 5 years down the road when these companies have been able to take advantage of what's available in terms of agentic technology.
Yeah. One of the things that, part of the debate a couple of weeks ago during that SaaS apocalypse was valuations, I think in general, are supposed to follow business fundamentals, but as we talked about a lot of the time, it is around narrative and not necessarily the case. There's some disconnect in the business fundamentals today, like the software companies seemingly aren't falling off a cliff from a revenue growth perspective. It's come down a bit. Retention rates seem to be holding, those sorts of things. So far, could change, right? But part of the bear case in the markets is around revenue growth, gross margin profiles, those sorts of things that could start to fall off. Like, how does the public markets or the private markets think about that from a time frame perspective? What are the drivers of like what could cause that? Like, you laid some of them out in that great deck you did. And maybe we'll walk through the bear case, then we can go through sort of the mitigants against it afterwards too.
Sure. Public market operating performance has actually improved quite a bit.
Which is interesting.
Retention is still pretty good, pretty strong. The Rule of 40, which is a mix of growth and profitability, has actually improved. Profitability has improved across the board. So there's really no signs of these things going to zero today. In fact, the number of publicly traded software companies raising guidance has been increasing. But all this goes back to this whole terminal value risk, right? Because when you're building a discounted cash flow model of a business, a quarterly fluctuation isn't going to make that much of a difference to the overall value of the business.
If you still think it's going to zero in 10 years, it doesn't change quarter to quarter. It doesn't
change. That's exactly it.
Yeah.
And so, the bear case, there's a number of categories across the bear case. So one is just defensibility and durability overall, right? One, customers are going to vibe code their own software and replace you. 2, an increased level of competition from new entrants is going to erode your margins and erode your competitive positioning. Budgets for software are going to come down. They're going to shift over to AI. Agents are going to replace seats. So if you're in the seat-based model, you're not selling seats anymore. So that's going to may not impact churn, your customers churning completely.
But there could be pricing pressure.
It could be pricing pressure, and it could impact your ability to upsell, which would impact your net revenue retention. And then there's top of funnel right? So for companies who rely on product-led growth and use things like search engine optimization.
When people are using LLMs to find, that's a different ballgame.
Web traffic has come down fairly significantly. So top of funnel issues. And then, I think you hinted to it, the gross margin question, which is, okay, well, many of these software companies are actually really well positioned to layer on agentic capabilities. So to go from being a system of record to a system of action. But in order to make this happen, you've got to pay the Nvidia tax,
right?
Which is you need. It's not.
Use of the models aren't free.
They're not free.
Yeah,
they're not free. You're going to be paying for inference, and so that could become a compression on gross margins.
Yeah, the interesting conversation too around like customers vibe coding their own system. Again, I think is like to some extent maybe a little bit overblown to say like everyone's just going to vibe code their own custom software all the time. Like, well, in some cases, like organizations that have a heavy engineering component, software companies that have a lot of people who know how to maintain and host this software. So yes, like I'm not sure I'd want to be the software sales rep selling to other software companies all the time. However, there's a whole subset of customers. Think about like, small and medium-sized businesses, like if you're selling software to, I don't know, chiropractors or dentists or what have you, the value to that customer, I'm interested in thinking like of spending time, vibe coding a new system, hosting it, debugging it, all that, like it feels like the end customer is also a point of perhaps durability.
Yeah, absolutely. I would agree with that. I don't think the whole vibe coding argument is widely applicable. I vibe coded a new capital markets website, which I thought was pretty good.
I saw it. It was pretty good.
I shared it with the team and I said, hey, we should use this.
Yeah.
Turns out there's a whole host of other issues related to that that I didn't think about.
Yeah.
And so that didn't fly.
Yeah.
But to your point, I mean, if you're running a dental practice or a physiotherapy practice, do you really want to spend your time maintaining your own software?
Every hour that you're doing that in Claude or whatever is an hour you're not doing an appointment.
That's exactly right.
Yeah. You were just at the Nvidia conference. I would love to hear what you saw, what you heard, and a little of Cole's notes on that, because that was seemingly the center of the universe for AI for a couple of days.
Yeah. So what I saw was incredible, and my head is actually still spinning from everything that I saw. I sat through about 20 sessions and interviewed, dozens and dozens of companies across the board. And the big theme there was around physical AI. A large proportion of the sessions, a big number of the exhibitors were all around physical AI. There were about 110 different robots on display, and they're really impressive. So physical AI is something that's just recently been unlocked. And I think we might be approaching the ChatGPT moment there. To give you a sense of scale, software is like a $400 billion to $600 billion market annually. The opportunity within physical AI, according to Jensen Huang, is about $100 trillion.
Because and I think the argument there is basically like you're talking about the labor market at large.
You're talking to the labor market, but you're talking beyond just the labor market, beyond the knowledge worker market. It's it's manufacturing, it's agriculture, it's transportation. Yeah. Right. It's even surgical, like it's medical. And the blocker had always been, well, to make robots and to make robots that can do productive things, you need data. You need to train these robots with data. Well, where are you going to get this data? You need robots to create this data.
So there's a self-fulfilling effect as it gets better and better, right?
That's right. Yeah. But robots are very expensive to build. So who's going to build these robots to create all this data to then train robots? Like the ROI case is not there. And it's not even totally clear that what the improvement rate of these robots would be, even if we had that data. Right. So those are two sort of historical blockers to all of this. A bunch of that has changed. So the models that we now have, like the physics models, the real world models, vision language models, which is VLA is a new acronym, they are now at a point where you could use simulated data, synthetic data, to train the robots.
Interesting.
And so you could have robots being trained in a simulated world without having had to have built actual robots.
It's fascinating.
Which is incredible.
Yeah.
So that's one. That was a huge unlock, being able to train robots with synthetic data, being able to train robots in simulated worlds, simulated environments. Yeah. So that was a one big unlock. So, okay, fine. We can get more data. We put more compute against it. Great. How much better is this going to get? Because with large language models, you could see the output pretty quickly. It's pretty one-dimensional. It's words, it's language, it's reasoning. With robots, there's physics associated with it, which is another dimension. There's dexterity, right? Like being able to touch and sense. Yeah. So there's a whole other number of dimensions associated with it. And so it's not
There's
clear.
There's a different layer of importance to like latency as an example too. Like if you're in a surgical environment or something, like you can't be 1 second late.
That's exactly right. So you need edge computing, and the edge computing needs to be there, which it now is. With the large language models, we had the scaling laws, right? So the more data, the more compute you put into it, you could reliably figure out what order of magnitude the improvement was going to be. That did not exist in robotics until recently. And so there's this idea of this dexterity scaling law. That's still early, admittedly, but what they've been able to show, up to now anyways, is the improvements of the actual movements and productivity of the robots actually goes up predictably in sort of this log linear fashion, similar to how the large language models did, with more compute and with more data.
Interesting. And the knock-on effect brings back to the markets a little bit is like one of the things we've heard from the venture community and the growth equity community at large, which we talk to every day, is hardware is kind of cool again as a result. Like a year and a half ago, like everyone wanted asset-light software, AI-enabled software, and today there's I think a much more open-minded to businesses that have some sort of hardware component integrated to them because of a lot of this advancement.
I think a lot of this advancement reduces a lot of the technical barriers, and it will accelerate development speeds and deployment speeds. I think though that the fundamental paradigm of venture will have to change to adapt to investing in physical AI. And the reason is because it's not like software. Like you're not going to be able to build an MVP in
There's a CapEx component.
There's a CapEx component. There's a supply chain component.
Yeah.
I think the investment horizons for venture will need to extend.
Yeah, it's going to change.
The trade-off is, for now anyways, is the moats will be deeper.
Yeah. Yeah, and I think that's what a lot of the investment community has come around to think in this AI world, like some kind of hardware component or something is a bit of a moat or a stickiness to it that can't just be vibe coded away.
Yeah.
Kind of a thing. Cool. Well, why don't we leave it there today? Dan, we're going to continue this and do a few more and hopefully bring some other folks onto the podcast. We appreciate the conversation today, Dan.
Thanks, Paul.
Cheers.